Hello, world. Welcome to the Coach's Playbook. I presume from Dan's face, we are in fact streaming live right now. Is that right, Dan?
Yeah, that was what the thumbs up was for.
Oh, it was, but I also see something up there that says it. You can never be too sure, So, anyway, we got a great little segment show, whatever you want to call it today. We're talking about gaps, or as heard Dan Hogue say, minding the gap, because we had a humdinger of a gap this week. And but before we get started, Mick was going to throw out one of our trader shout outs. Mick, who you got for us?
Yes, thank you. Joey Vettleton up $5,000 today, trading the NASDAQ. Way to take advantage of this volatility and wide ranges.
Nice. Well, guys, I took yesterday off. Had it in the books for a long time to do so, and it's a pretty common occurrence. The correlation between the market going completely hangwire and me being out of the office. It's a pretty good correlation there. And lo and behold, it happens. So since we're talking gaps, why don't you guys tell me a little bit about
It's called the Hodgman trade. Hogue and I coined this last year. Every time I was out of the office, like I was yesterday, every time I step away and on PTO, the market always goes higher.
Yeah. And I'm not trying to do it either. I had no way to plan months ago. It's like, like the Monday, the election stuff will be over. Whatever. And a lot of stuff happened. So who wants to break down a little bit of the gap yesterday, and then we can go into kind of how to treat stuff like that? Dan?
The guy that was off yesterday, for sure.
Oh, Christ. Hogue, you tell us.
Sure. And hey, I don't know if it makes a difference, but I'm off on Fridays. So if that means the market's going to go crazy, you've got your fair warning.
Well, it became the Hogue Hodgman trade at some point. So
yeah. I was going to say, I've got to start paying closer attention to when you guys are off.
We should put that out as an indicator, I think.
Yeah.
here's my schedule for the next 6 months of when I'm not
give
working.
Everybody access to the calendar.
All right. So the gap that happened yesterday was an extended trading hour gap. So it happened over the weekend. So it appears on an extended trading hour chart. Most of the time, you're not going to see extended trading hour gaps unless it's a weekend, unless something really unusual happens. So we had an extended trading hour gap yesterday. I think it's now been closed, but what I'd kind of like to focus more on is the regular trading hour gap. So we have your extended trading hours, which is the 23 hours that the markets are open. And then there's the regular trading hour ranges, which are basically the old pit trading hours. Let's say gold is 7:20 Central Time to 12:30. Currencies and treasuries 7:20 to 2 o'clock. Crude 8 o'clock till 1:30, and the S&Ps and the indexes 8:30 till 3:15. Those would be the regular trading hour ranges. So when the market opens, and let's say tomorrow we open outside of today's range in any of those markets, it's indicating a probability that the market is out of balance and that a potential change is coming. So you've got today's range, you've got yesterday's range, I should say, and you've got today's range considerably higher. What usually I'm going to be thinking or looking at that time is, okay, how big is the gap? Number one, what's the probability that the gap is going to be closed? And if we can't close that gap range to range, not like price to not like open to settlement, it's range to range, then I'm going to be looking at opportunities in the direction of that gap. So again, if the gap is higher yesterday, today's open, if we can't close that gap, I'm going to be looking for directions for price to continue to move higher as it continues to present possible acceptance of higher prices. When you close the gap, that changes the strategy just a little bit. But it's one of the ways that you can use gaps. It's very subjective. If you can't close a gap relatively early, you look for opportunities in the direction of the gap. The gap is lower, you look for continuation to the downside. If you can't close the gap relatively early. If the gap is higher, you look for opportunities to go long if the gap isn't closed. One of the kind of simple rules, but it tends to, if you look, when we open with a gap and we can't close that gap, the tendency does tend to go in the direction of the gap. Just my initial thoughts. Maybe I yammered a little bit.
No, I think that was good. I don't think that was yammering. I think that was some knowledge being just filtered to everyone out there. Does it make any difference as far as, do you treat it differently? Say we're talking a product like equities or something like that. Does it make any difference whether it's a big gap up or a big gap down? Because I feel, and this is just me completely, this could be bro science, but I feel like a lot of times big gaps tend to be, gaps down. Something bad happens versus this was unusual. It's unusual to see 1,000-point Dow rally. I can only think of things with like during the financial crisis, if they reached some deal or something over the weekend or
Right.
something like that. It's just unusual to see. I mean, hell, we had like a vaccine and the resolution of a presidential race. Well, I think resolution, but everyone on the internet can wax philosophical about that. But do you treat those any differently, or you just both of them kind of follow the same dynamics?
It's a great question. You're right, especially when the equities are concerned. Some of your bigger gaps are going to be to the downside, but even if it's a larger gap to the upside, when you think about it, a larger gap has a lower probability of being closed. Doesn't mean that you're not going to get an opportunity for better trade location in the direction of the gap, but I would agree. Most of the time, there is a news event that creates that big downside gap. But we also, as we saw this weekend, we saw a news event that created a big upside gap, which, I think we kind of closed today. I don't know. Let me look here.
Which indice are you looking
yes,
at?
we did.
Right.
We did in the S&P.
One thing Jack, you mentioned bad news, we gap lower. That's with equities, but with other commodities, you have bad news, you gap higher. You talk about gold, grains, any of those other products that are, physical goods. It's kind of interesting. Bad news, gap higher with those. Bad news in the equities, you gap lower. It's always interesting to watch the gaps, and I strongly suggest anybody listening to this pull up the pit session gap chart, and then pull up the extended hours chart, the 24-hour, 23-hour chart. They look very, very different. And with a bulk of the trading day happening in the overnight hours outside the old pit trading sessions, you will see a lot of gaps in the pit sessions. It's a pretty common occurrence. So you can try and interpret gaps on a short term, on a daily chart, and see what happens with the rest of the week. It's also very interesting to see gaps in the markets and have a longer outlook where you might be looking at a gap from months and months and months ago, and you see price kind of floating towards that level or sinking towards that level. And people always say, or I've always heard, gaps eventually get filled, and I do agree with that. It's a matter of time. They don't get filled, and I wouldn't bet $1 on, oh, we're by a gap, we're going to fill the gap. That's not what that means. But over time, with price fluctuations, you do a lot of times see gaps. And, for someone like myself, where I'm looking at higher time frame stuff, if I see, crude oil drifting towards a gap, I'm kind of thinking that, doesn't mean it's going to happen that week or the following week, but I will play for a fill of the gap, and it usually comes to fruition.
Gaps that are left unfilled tend to be weakness in structure. So you move higher, and like say in the S&Ps, you're moving higher over time, and then you have a gap that doesn't get filled, and you continue to move higher. That gap is considered a weakness in the structure. And this is straight from the words of Jim Dalton. Gaps are weakness in structure, and they, like Mick says, they do tend to get filled. Maybe not today, maybe not next week, but at some point in the future, they're usually going to get filled.
And we do have, if I'm not wrong, that was, the story during the rally out of the early days of the pandemic, and maybe that's different. There's still a lot of gaps hanging out there.
Yeah.
Yeah.
Without a doubt. And I think there's something that both of you guys said, and I want to touch on and make a bigger stink about it because I think it's important. Mick, you talked about longer time frame, looking back over time and looking to see those gaps close. And then John, you were talking kind of right off the open, what you're looking for. And I think it's really important to recognize there's two different ways to go about this. Mick's looking at that long term, which we all love thinking long term. And I know a lot of people here thinking about day trading, looking for that intraday opportunity. So I think there's a way to mesh these two things together. Number one, the way Mick's talked about looking at this, looking at the regular trading hours chart, looking back over time, highlighting those locations where the gaps are. And as that market starts to approach, the closer we get, then you can start to look for some intraday or some day trading opportunity towards those levels. Now, when we start to open up, and let's say we did open up with a gap, John pointed out something really interesting and important to recognize. If it doesn't close that gap relatively quickly, stop looking for it and look for that next opportunity, because eventually it kind of gets put behind us. Everyone's focused on the good news. Yesterday it could have continued higher when we all woke up with a complete shocker that Pfizer has a vaccine that's 90% effective. I mean, I'll be honest with you, I didn't wake up expecting something like that. We could have continued to extend, but we saw right off the open that gap. Instantly, the market approached that gap and started to close things down. So I think it's really important to recognize, get an idea of the timeframes that you're looking at when these gaps are going to get closed. If it doesn't close relatively quickly, eventually over the next few days, the market's going to start to forget about that gap until that market starts to rotate back over. Once it starts to rotate back over, that's when you jump on what Mick's talking about here. You start looking towards those levels and waiting for your opportunity to strike towards that.
Once they're back in the neighborhood.
Exactly.
Nice. Yeah. So just coming back to this too, is we saw some rotation as well. It's interesting to see that back in the markets where the NASDAQ has been underperforming unless it's zoomed back in the next few minutes. I think we got some real interesting trading ahead of us for the rest of the month. We got
rest of this year. I think by mid-February, maybe things will slow down.
No doubt.
Yeah.
I don't think we're looking for a very peaceful holiday season this year.
Right?
No. I suppose not. But, we can hope for something good. Maybe everything will, vaccines, good news. It's unfortunately a bear of a vaccine. So we'll see if we can put our logistical minds as a country together and get this thing done.
Yeah.
So we got a great question here from Jose. What is the relation between gap and liquidity?
Well, gap is a area that the market skipped without trading in the regular trading hour or in the extended trading hour. Liquidity talks basically to the thickness of the marketplace, and you're going to have less liquidity at night than you're going to have in the regular trading hour session because these are US based. But liquidity, but a gap is more of about a price change that occurs overnight between regular trading hour session and regular trading hour session most of the time. It may have something to do with liquidity. You can't tell me that the gap to the upside yesterday wasn't exacerbated because there's already less liquidity in the marketplace due to the election. So, it can exacerbate the distance of a gap when there's less liquidity, but they're not necessarily directly holding hands there.
And I think something to add to that, just for like perspective and how this works. If we go back to March when we started to see all those limit downs, I think that was a prime example. When the market is not open, if we're prior to entering in, that market's not open, you start to see the market actually creating that gap. And so I think if you look back to March and kind of recall or take a look back there, we saw that market, we were locked out prior to the open. And in the pre-market, you saw the market all of a sudden start drifting lower, and we instantly hit that next circuit breaker before we even had a single trade executed. So that's kind of a visual way of seeing these gaps. When there is no liquidity, there's one side is going to push that thing lower. And that's exactly what we had happening.
Mm-hmm.
It's always interesting to watch, and I don't recommend watching the market, open every time because you gotta have your life too. But like after these big events, I remember if I'd be in the office on like a Sunday, it would be just sitting there because you have positions on, kind of sitting there nervously being like, where are the first few of these bids and offers going to meet?
Mm-hmm.
And then you
Mhm.
just know how screwed you were. Because like until then, it's just, kind of everyone's just trying to feel out and decide a new price. It's really like watching a brand new pure auction there. So yeah, always a wild thing. And do you have any other questions? Or do we have any other last thoughts about the gaps?
No, that's the last thing I got.
One thought, since liquidity got brought up, I just want to make the distinction between volume and liquidity. We've seen heavy volume in the last, several days since the election evening. Liquidity has been very low despite the high volume. Liquidity basically is referring to how easily you can get in and out of a market. If you're looking at a dome or a price ladder for execution, you'll see that, the bids and the offers are much smaller. There might even be a little bit of a gap in between the bid and offer itself. Normally when, an efficient liquid market, bids and offers are very tight, size is bigger. So we've seen a lot of illiquidity lately, but we've had very high volume lately as well.
Yeah, it's all about like the depth of the book as opposed to, if we move 1,000 points on the Dow, you're going to trade a lot of contracts along
Oh
the way.
yes.
Oh
But
yeah.
it doesn't mean there's good liquidity.
Mhm.
In fact, it likely means the opposite, almost exclusively. So
Yes,
definitely something to watch
exactly.
out for. All right, Dan. After the gap talk, do you have some pep talk for us in the form of a quote?
I do. Well, today is the Marine Corps birthday, 245th birthday. So Semper Fi, New Rod, all my Marines out there. So today I'm grabbed one from old St. Mattis, Jim Mattis, former Secretary of Defense, and one of our more famous Marine Corps generals of modern time. And he has some pretty incredible quotes out there. I picked this one because it was not very Marine Corps, but more something that kind of goes with trading. The second half, I should say. The first part is, you are part of the world's most feared and trusted force. But first you must engage your brain before you engage your weapon. And in this case, our weapon is our mouse. And before we engage this, we got to engage this.
That's great.
That's good. I
Great
love it. I
quote.
say we end it there. So, Hogue, you're back in the saddle. Why don't you sign us off?
Hey, wonderful. Great to be back. Ladies and gentlemen, trading is a lifelong learning opportunity. Get out there, take your time, be patient, look for those profits, trade well, and we'll see you next time.